Who wants to learn about buying properties without using a bank? Okay, this I can promise you, if there are no questions at the end of my presentation, I'm going to know that you guys can't hear me or something, because this will generate questions. In fact, you know what? I never do this. But I'm going to specifically skip stuff just to see if you guys are paying attention, just to see if you guys are going to ask a question, okay? I just want to make sure this microphone thing here works. So I'm going to specifically skip stuff, and I'm going to skip specifically some of the super juicy stuff, just to see if I can elicit some questions from you guys, make this a little bit more interactive. All right, so the topic again is buying property subject to the existing financing. And for us, this is the way that we love to buy properties all the time, because as much as we like to use our own capital, right, you can never have enough capital in your real estate investing business to make it all the way. That's why you'll always have hard money lenders who are lending at almost private money lender rates right now. That's why you'll always have self-directed IRAs. That's why you'll always need other people's money to be a successful real estate investor. Even if you have $1 million, right, in today's market where the average price in Austin, Texas is over $400,000, at most you'll only be able to be running two projects at a time. Is that going to make you enough money to make you leave whatever it is you're doing now or give you a comfortable living? For many of you guys, you'd probably say, no, you need more access to capital. You need to be doing more deals at the same time. And using this strategy is a way that we've found we've been able to make our dollar holler, our dollar go further, our ability to buy more properties and have more projects going at the same time. So we're going to go over how you guys can use this strategy yourself to invest in real estate. For us, it is probably one of the most powerful techniques that we've used since we've been investing in real estate since 2003. You buy a property with as little as zero money down, right? So you just take over someone's payments. Now that assumes that they're current. In many of the situations where we're buying a property subject to the existing financing, we are usually buying it subject to from a motivated seller, and they're usually motivated because they're going to foreclosure. And if we're buying that property subject to the existing financing, we are usually bringing money to the table to reinstate that loan, right, to bring that loan current. So best case scenario, you get it before they start getting behind on payments, but probably an average case scenario, you're looking at reinstating that loan to the tune of $10,000, $20,000, or maybe even $30,000, okay? You agree to make the payments on their loan going forward in exchange for the deed. So the way that we do things here in Texas is we have a promissory note and we have a deed, okay? These are two separate instruments that are filed separately at the county, okay? Each one of these security instruments are notarized. The promissory note outlines what the debt is on the house and what the interest rate is and who you make those payments to, okay? The deed represents, well, who owns this thing, right? It shows who the owner of that property is. Those are two separate things, and as a result, you can take the deed without necessarily paying off the mortgage on the property. So you can take the deed subject to the existing financing that the seller already has in place. For us, it's been a great way to pick up rental properties, renovations, our fix and flips, buy homesteads, and even wholesale property, right? So if you're selling a property to another investor, as an example, man, nothing's going to make that property sell faster than you telling them this comes with a loan. It already comes with financing. So again, it's a great way to help other investors make their loan payments go a little bit further as well. The details can get quite complicated, and you need to have a good power team in place to make sure that everything goes right. For us, for the long-term buy and holds, our rental properties, our wraparound mortgages, etc., we look for properties with low fixed rate mortgages, right? Not adjustable mortgages, but low fixed rate mortgages. We also look for no balloon payments. Now, balloon payments in this lending environment are very rare, but occasionally you'll see those in there. We also, for our short-term holds, for our fix and flips, all we want to do is make sure that there are no prepayment penalties. Again, in this Dodd-Frank regulated environment, you rarely see those anymore, but occasionally you will run across those. Really, for the short-term buy and holds, nothing else matters. It can have a high interest rate But as long as that interest rate is still lower than your other cost of money, as an example, it's still a good method to use to finance your properties. You'll want to review your contracts and close at a title company. In fact, I don't recommend that you do anything in terms of buying and selling real estate without doing it at a title company. There are some people who will just say, well, I found a general warranty deed online. I'm just going to make a copy of that and I'll just have them sign over the general warranty deed. How many of you guys have heard of a quitclaim deed? You ever heard of a quitclaim deed? Do you know the value of a quitclaim deed in Texas? It's zero, okay? So for those of you who are new to this, you may say, I actually had an investor who thought he knew everything, who came here from another state and told me, this is not you. This is not you, I promise. But it was someone who came here from another state, and he said, well, I've got a quitclaim deed on this property, and I'm looking for financing to do the renovation on it. And of course, all the investors who know Texas and invest in Texas were like, we're not touching that thing unless you get a general warranty deed signed over. Well, as it turned out, he could not get a general warranty deed. So did he really have control of that property? He didn't have the ability to sell that property, right? Which is where ultimately the exit strategy came out of it. So again, having some of this tribal knowledge, understanding some of these things as a real estate investor is very important to your success or your failure. And you'll hear a lot of people who say, well, in a divorce, for example, the wife signed over a quitclaim deed. Does that do it for a title company and allow you to get title insurance on the sale? No, it does not. So if you came here from someone else, welcome to Texas. Please use a general warranty deed, not a quitclaim deed. How many of you guys are familiar with the due on sale clause? Keep your hand up if you are worried about the due on sale clause when buying a property subject to the existing financing. Okay, so I just want to make sure I know who I'm talking to. This is one of the items in one of my personal promissory notes. This is what we call the due on sale clause, and I'm gonna summarize it for you. But you can look at your own mortgage and look at the due on sale clause in your own mortgage to verify that the words are exactly the same or even roughly the same. Basically, what it says is if this property is sold, or even if the beneficial interest is transferred, for those of you guys who are thinking like, I'm going to do a land trust and I'm going to hide my interest in the property and all, that's a different topic. But in the event that you sell the property and you do not pay off the loan, or you transfer the beneficial interest of the property and you do not pay off the loan, it says, and I quote, the lender may, at its option, end quote, call the note due and payable in full. What do you guys think about that language? Strong language. Strong language? Did you just say it doesn't say shit? What? What did you say?
I said does not say shall.
Does not say shall. Okay. I'm like, dang. Well, I'll take that too. But to me, it sounds about as hard, as harsh, as strong as a what donuts, right? I mean, this says nothing. It says I may, at my option. I may not, right? It doesn't. Does it say in here that I will call this note due? Does it say in here that this is illegal to do? I didn't read that either. Does it say anything about a due on sale jail? That was a joke. I'm going to keep testing this mic. When I said what I thought she said, this mic worked for everybody universally. Okay, but no, this phrase that they've set up in here says that they have the right to do this. Right? It doesn't say that they will do it every time. And trust me, we've tested it on in many ways over the last 13 years. But nearly every loan that's been originated after roughly 1995, 1996 has one of these provisions written in there, right? Go check it out on your personal mortgage tonight when you get home. And when you buy a property subject to the existing mortgage, you are technically triggering, if you will, this clause, right? You are effectively giving an owner, you're effectively giving a lender the right to call a property due, or call the payments due in full. Now, what we've experienced, and we have tried this many different ways, is this. Historically, lenders do not want to call a loan due, do not want to exercise this clause if the payments are on time, if the loan is current. They have no interest in taking that property back or trying to foreclose on you if the loan is performing. They are getting back their money as they have outlined it in that exact promissory note, and they don't have an interest in doing that. They are in the business of holding paper. They are not in the business of holding properties, right? Banks don't want those properties back. Some of the diversions we've seen some investors do. We have seen some investors try to disguise the sale by using a trust to transfer the beneficial interest without recording the deed under the Garn-Saint Germain Act of 1982. That's a provision that they're using to roll over to be able to use this. And the attorneys that we've talked to have said, nope, that provision doesn't roll over the same because it's not a family limited trust that many of these people are trying to transfer it into. Some investors and even some attorneys will recommend that you send a letter to the underlying lender to say, hey, I just want to let you know I'm buying this property subject to the existing mortgage. If you have any sort of problem with that at all, just please return my check for $20,000 to reinstate this loan, and we'll just call the whole thing off, okay? Some attorneys, some title offices will do that, and the ones that have always told me that I've never had a lender send the check back or send any response back at all. But for us, when we buy these properties subject to the existing financing, we neither confirm nor deny that we bought the property subject to the existing financing. All we do are two very simple things. Number one, we reinstate the loan. And number two, we make the payments on time each and every month. Because at the end of the day, that's the real thing that will trigger a lender foreclosing on someone, right? And that's through the default and acceleration clause that is in the promissory note, not necessarily the due on sale clause that's in the note. Some details when buying a property subject to, some of the steps that we follow specifically. Number one, you have to find a property. What are great ways to find a property, find motivated buyers? What are some of the marketing strategies we use to find these exact types of, motivated sellers? Direct mail, yes? Direct mail to what kind of a list?
Foreclosures.
A foreclosure list, right? The pre-foreclosure list is a great way to find these people. They've already messed up their credit, right? So they're, in some cases, easier to sell because people who have not yet fallen behind on payments, one of their questions is, well, how do I know that you're going to continue to make payments on this loan going forward, right? But someone who's already messed up their payment, now they have an opportunity to bring that loan current and get payments made every month on their behalf. So it's an opportunity to build back up a credit score that may have been put down. So once you find that property, you'll explain to the seller that you want to purchase that property by taking over payments on the existing loan. That has benefits to everyone who's involved. For you as the investor, for me as the investor, it's allowed me to go outside of my maximum allowable offer formula. So as a real estate investor, what's our maximum allowable offer formula?
30% minus 70% 30%.
Okay.
70% ARV minus repairs.
Okay. What did you say?
70% ARV.
What did you say the first time?
30.
I like that. I like that. I'll take that. Let me know when you find someone who will do that. Yeah. I do like. So basically, in some cases, they're going to be paying you, right, to buy the house, right? So the maximum allowable offer formula, guys. If you are new to this, please write this down. 70% of the ARV minus repairs. ARV stands for after repair value. Your maximum allowable offer formula for a fix and flip, 70% of ARV minus repairs. Everybody got that? Universally? Yes? Yes? Yes, sir, Michael.
You said, okay, we're taking this thing to a title company. Does every title company?
No.
Okay.
No.
That's good.
Yeah. So let me just.
You can skip, you can go through your things if you can just come back to it.
Okay, I will.
Okay.
Thank you for
Thanks.
granting me that permission. I
No problem.
do appreciate that.
No problem.
Yeah. We're good friends now, so. So everyone has the formula universally. Yes, yes, yes. You all say yes. So then everyone won't mind a pop quiz. Yes, yes. ARV is 200,000. Repairs are 50,000. What is your offer?
90.
Thank you, Barbara. Thank you, Barbara. Appreciate that. Everybody got that? 70% of 200,000 is $140,000. 140,000 minus the 50,000 needed in repairs means your maximum allowable offer is $90,000. So for me as a real estate investor, that's the offer formula that I use, expecting that I have a pretty high cost of capital. So if I am, for example, using a hard money lender, right? Hard money lender is going to charge me 2 points on the purchase and 12% interest, right? So let's just round up to make my math easy. On a $100,000 loan, I'm paying $2,000 in points, and then over the course of a year, I'm going to pay $12,000 in interest. Now, I can get it done a little faster than a year, right? So I'm probably going to get it done in about 6 months. 6 months of interest payments on $100,000 is going to cost me $6,000 plus the $2,000 in points. Yes? Everybody follow that? So would I be willing to give some of that back to the seller if I'm able to take over their loan subject to the existing financing? And let's say that the seller's loan is a 6% loan. Yes?
Absolutely.
It should all be yes. Just want to make sure. So typically for me, and the way that you find out how much additional you offer, the exact way to find out is to figure out what their interest payment on their loan is and how much interest you'll be paying every month, and subtract it, for example, from the interest rate on what an alternative financing strategy would be for you. In some cases, hard money loan, in some cases, private money loan, in some cases, it may even be some type of a line of credit, for example, with your bank. That's the exact number to get it. But usually, historically, what I found is that to get a seller to agree to this, usually if I offer them another $2,000 or $3,000, then I get to keep the difference, because another $2,000 or $3,000, I'll offer you $100,000 or I'll offer you $103,000 if you allow me to keep the loan in place. They're going to say, 103 sounds really good. Tell me more about that solution. So let's go through the rest of it. So you'll be able to pay more and maybe even be able to get more if you don't have to offer them more to take over the loan subject to. If the owner is behind on payments, just reinstating the loan, that will help them more so than paying off the loan, because your credit score and your credit score is like no one can explain it. That's number one. But what helps is to have those big debts, those big amounts of debt that are being paid off regularly versus just wiping out or removing or just paying off, for example, that big debt. So it actually helps their credit over time if you're able to continue to make the payments on that large mortgage. If they resist, which sometimes they'll do, one of the things that you can do is put a time frame on it, on how long you will have this mortgage in your name, or excuse me, how long you will have that mortgage in their name while you are the owner of the property. The other thing I've been able to do to convince people who are a little bit leery of this is I've asked them, is it okay if I prepay your mortgage payments for the next 6 months? Would that be okay with you, Joe? You would be fine with that, wouldn't you? Yeah? So wouldn't that give you more security about me, right? I'm going to pay it whether I'm paying it over here or whether I'm paying it over there. And if it gives me that cheaper cost of money, then I will prepay that for you to make you feel more comfortable, to allow me to take over the payments. You'll get the property under contract with a truck contract. Everyone knows how to get the contract, yes? Yes? Anyone not know how to get the contract? Okay, Google TREC, T-R-E-C. Google TREC, T-R-E-C. If you go to the TREC website, you will click on Forms. And when you get to Forms, you will look for the contract titled, for at least single family, you'll look for the contract titled 124 Family Contract. There's about 40 different contract addendum addenda, notices, etc. out there, so you have to look for the one for single family 1 to 4 contract. You'll also get a subject to addendum from a title company. Now, the question was, hey, do all title companies do this? The answer is no. In fact, only the investor-friendly title companies will usually allow a transaction like this. So you need to make sure you're at the right title company. Now, if you ask your title company, hey, are you an investor-friendly title company? What are they going to say?
Sure.
Yes! Why, we would love to. And I think they have that voice too, right? Isn't that right? Yes! Why, yes! And you're talking to the sales rep, and they have no idea, for the most part. And I'm stereotyping, and I apologize. How do you find out if you have an investor-friendly title company?
Talk to somebody.
Talk to somebody. What question do you ask them?
Do you do subject twos?
Do you do subject to? Yes.
Who do you use? That's my big question.
I use Alan Seshker. C-E-S. I'm going to spell this one time. Alan Seshker. C-E-S-H-K-E-R.
Wait a second. Go slower. C-E-S.
C-E-S-H-K-E-R. Seshker. German for hard to pronounce and impossible to spell. Yeah. And we close wraps here. That's what it stands for. So the way to find a great title company, an investor-friendly title company, is ask them, do you allow assignments? That's an easy one. They should all say yes, right? This is for your wholesales. Ask them if they allow pass-through title insurance when you have an A to B and then a B to C transaction. Ask them if they allow pass-through funding when you have an A to B transaction and you don't have the money to fund the A to B transaction, but you want your end buyer who's funding the B to C transaction fund the whole thing. If they say, what did you say? Then what do you know immediately?
They're not investor friendly.
Thank you very much. I cannot wait to do business with you. Never. You do need to have an investor-friendly title company to do this for you because you want to make sure, number one, you're with someone who understands it, who doesn't just say yes, who actually can, and number two or 3 or 4, whatever number I'm on, someone who can write it in a way that is beneficial to both the seller as well as to the buyer. And there are ways that you can make it just beneficial to the buyer, you want to make sure that the seller also has protections as well. So you'll take that contract to your investor-friendly title company and go through a subject to checklist that they will give you to make sure you have all the documents in place. You'll purchase the property, so the deed will transfer to you, but again, the existing loan, the existing mortgage will stay in place, or rather a new mortgage will be created, and that's called the wrap-around mortgage, okay? Exit strategies, again, fix and flip. You can renovate and sell that property. Buy and hold, you can hold it as a rental property or buy and hold it for a homestead, or you can sell it on a wrap-around mortgage to an owner finance buyer, yes? So,
Just for a second, during this process, do you do a title search and make sure there's no other liens against the property?
hell yes. Yes. You're not going to close a title company without them doing a title search for you, right? Otherwise, you wouldn't even need yes, you have to have a title search. We were just talking, I was just talking to one of my colleagues, and he said, I'm looking at a house. ARV on this house is like $250,000. There just so happens to be $10 million worth of judgments on this house.
Gee,
Oh, really?
what a deal.
What a deal. I mean, there are ways for you to find that yourself, but title company is always going to be the one to find that and to solve that problem for you, because that deal may or may not be a dead deal. All right, overcoming seller objections. So how many of you guys would let me buy your property subject to the existing financing in this room? That's pretty much what I thought, right? And you kind of look me over. I don't think I trust you, right? Why don't you trust me, Barbara?
It's not I'm not trusting you.
It's not you, it's me. Do you use that a lot? Why don't want to tell me?
I don't want to continue liability. I don't want it on my credit report.
Okay. Anybody else? Anybody else sell me their house subject to the existing financing? No, none of you. Great.
Why would I do that if I'm not motivated to sell?
Why would I do that if I'm not motivated to sell? Listen, guys, my expectation was that none of you were going to say, why, yes, I can't, let's do that tomorrow, right? Because all of you guys have your life together. All of you guys are working, have money, right? You're not giving me the, my dog died, my truck broke down, my wife left me, and I lost my job, okay? If all of those things were in your, going on in your life right now, if you guys were facing foreclosure, if you were facing foreclosure in a week and you really didn't have any other options, if your property needed a lot of repairs to be what a bank would call habitable. What does that mean when I say habitable? That means loanable, okay? For most lenders, except for hard money lenders, right, and private money lenders, one of their requirements is that the house be habitable before they make a loan on it. Wells Fargo is not going to make a loan on an uninhabitable house. If your house is uninhabitable, and just by the way, just to be clear, uninhabitable does not mean that someone does not live there today. I have seen many lenders call houses where people have been living for 30 years uninhabitable and then won't make a loan on it, okay? It doesn't matter whether or not someone's been living there or not, okay? If your house was uninhabitable, if it didn't have bathroom or kitchen, or it was a disaster zone, or my favorite, if it had a sunroof in it, which is, yeah, some of you guys will get that slowly. I'll just let that one sink in. If it has a sunroof in it, right, you're not going to get a loan on that property. So you may not have the ability to list it, for example, on the MLS, right? If you didn't have the, and a lot of people will say, well, you know, Sean, the values have gone up so much. Why would anybody ever want to do this? Guys, equity, appreciation, that does not equal cash, right? And at the end of the day, even if you have $100,000 in equity, that you still may not have the cash to be able to fix and repair that property because of maybe some credit issue that you have. And especially if you've been behind, what's the likelihood of a regular traditional lender lending you money if you've been behind in the last 3 years? Roughly the square root of 0, right? So you may not have any of these alternative strategies. If you were facing foreclosure, what if you wanted to sell the house quickly? Sometimes we get strange calls as real estate investors from people who just want to sell it right away. Sometimes we get calls as real estate investors from people who say, I don't want to deal with a realtor. I don't want anybody walking through my house, right? If one of these things is in your life right now, then you are a candidate for allowing an investor to buy your house subject to the existing financing. If you are current on your payments, and if you're one of those people who, yeah, every month I make another $300 to the principal on my loan, guys, I'm not buying your house subject to the existing financing. Yeah, we've already cleared that up. But if something else is going on, that's where that opportunity becomes presented. So what are some of the objections that you can, what are some of the ways you can overcome objections? Number one, why would I buy your house, reinstate your loan, which is going to be $10,000, $20,000, or $30,000, and then say, well, that was fun, and stop making payments? Why would I reinstate your loan and then put probably the average renovation cost here in Austin somewhere between $30,000 and $80,000, right? Why would I reinstate, put all of this money into renovating your property, and then say, well, that was a fun way to spend my money. Now I'm not going to make payments anymore, right? So those are the two biggest ones. Obviously, you have skin in the game, and you need to communicate that to the seller. And then working with an investor, stopping foreclosure today. Like right now, in many of the cases, the houses we buy, they're going to foreclosure in a matter of days, right? Stopping foreclosure today and then hoping that I'm going to keep you out of foreclosure, isn't that a better solution than just letting you go straight to foreclosure right now? Obviously, in many cases, that is. For me, I also add information about my financial stability. I let them know that this is something that I've been doing since 2003. In fact, many of the houses that we still own as rental properties today, we bought subject to the existing financing back in 2003, and I've got the history to prove it. So that also makes people feel comfortable. Sorry, this thing's getting a little touchy here. Again, and let's try this again. Again, let them know that you have skin in the game. And one of the things that I like to insert, especially if the conversation is getting a little heated, which sometimes it does, is I get to ask someone, I don't know, Joe, if you are a religious man or not, but what I can promise you is this. If I buy your home and reinstate your loan, if I buy your home subject to the existing financing, I reinstate your loan, and then I do a $50,000 renovation on your property, every night when you go to sleep, whether you're a religious man or not, you're going to go to bed and you're going to say a little prayer, and the prayer is going to go something like this. I hope she defaults. I hope she defaults. I hope she defaults. I hope she defaults. Because the way that we buy property subject to is through something called a wraparound mortgage. That wraparound mortgage puts the seller in the position of a bank. And if I stop making the payments on your loan, you get to foreclose on me. So every night, whether you're a religious man or not, you're going to say, I hope she stops making payments. Because I would love to move back in that house, and I'll foreclose on you way quicker than Wells Fargo will foreclose on me, right? Because in Texas, it only takes 21 days from the final notice to the actual foreclosure auction. Now, in truth, it's going to take you about 45 days to really get through the entire process, but you are going to be on it way more than Wells Fargo would be. And what a benefit to you if I do stop making payments after I reinstate and after I fix the house, that you get to take this house back, yes? And by that time, you may be ready to move back in because I made it into a palace, right? So that's something that will cool down the conversation and give them some perspective, because sometimes they're very much in kind of their thought process as they've gotten into the situation that they're in now.
Is wraparound mortgage, is that the only way Texas allows you to do it subject to?
No. So the question was, is wraparound mortgage the only way Texas allows you to do it, buy property subject to? No. So when we first started buying property subject to, we did not give the seller the ability to foreclose on us in the event that we stopped making payments. In fact, many of the properties that we own today, subject to, the sellers don't have that ability. And the way that we do it now to make our attorney feel good and to make it fair to everyone is we create that wraparound mortgage. That wraparound mortgage is the tool that gives the seller the ability to foreclose on us in the event that we stop making payments. Yeah? And that's really the right way to do it. There are other ways to do it, but that's really the right way to do it, and that's what we would suggest for you. And that's how Alan does it, by the way, how Alan's going to require that it gets done. So some of the tricky details. You'll want to verify the loan balance, so you'll send in an authorization to release loan information form to the seller's lender to be able to get information about the reinstatement, about the payoff, and to also order an escrow analysis. You'll want to make sure to order the payoff good through the day of the auction. We all are going to say, well, we're closing on the 15th of the month. Why would I make it the close date good through the day of the auction? Because, as someone said in the audience, shit happens, right? And sometimes even with our best intentions, by the time we make it to the title company, we find some surprise on title. And sometimes those surprises on title need to be worked through, and that's a process that takes time. The other issue we find is sometimes getting the payoff and the reinstatement from the lender is not very easy, right? And something that takes time. And giving yourself as much opportunity as you can is helpful, because reordering a new payoff and a new reinstatement when it's just a couple of days before the auction is very difficult to do. Not impossible, but it takes a lot of time on the phone not taking no for an answer as people tell you, no, we don't have time to calculate that, we're taking it foreclosure. You'll want to buy this property in the name of an LLC. We have 2 different naming recognitions that we use when we're buying these properties, and it depends on our exit strategy for the property. If we're keeping the property as a buy and hold long-term rental, we will set up a new LLC for that property. And we will name that new LLC the last name of the current owner dash the street name of the subject property, comma, LLC. Why do we do that?
Specific to that property?
It's specific to that property. How many of you guys have called the Secretary of State to see if a name is available for you to create an LLC? How long was that phone call? It was a while. Charles, what's your last name?
Koval.
Koval, Covill. And Charles, what's the street name you live on?
Water Race Court.
So Koval dash water 1234 Water Race Court. Do you pretty much know when you call the Secretary of State that you're going to be the only person that called that day who got a name right on the first try? Do you think that LLC name is available? I can guarantee it, right? So that's one of the things that we do. We'll write that name into the contract, and then we won't start that LLC until the day that we buy the property, because we don't want to start it before, because what if the closing doesn't make it to the finish line, and then we have Koval dash 1234 what the heck?
Water Race Court.
Water Race Court as an LLC that we paid the Secretary of State $300 filing fee and paid an attorney several $100s to create for us, right? So that's one of the tricks that we use. And also, in the event that a lender ever was to go back and say, hey, we want to look at all the deeds to see make sure that they match the notes, right? They'll see your last name on a property that you have a mortgage on and the address of the property. So they're going to think there must be some family planning thing going on here. They're not going to think that Chanilla Grove just bought this property subject to the existing financing, right? So that's one of our strategies that we use. Now, if we're keeping it for a short-term fix and flip, right, we're only going to hold it for a few months, then we'll just buy it in one of our normal fix and flip company names. Because even if the bank were to, oh my God, find out, which is what so many people are afraid of, that never happens, we're selling it so quickly because we're buying, fixing, and flipping that they don't even have enough time to actually go through the foreclosure process. You'll need an insurance policy. Highly recommend Mike Monzingo write that policy for you. You'll need to name the original owner as an additional insured because the bank will check to make sure that is the case. This is very crucial. You'll also need to name the lender in the mortgagee's clause because the lender will look to make sure that that is the case. You'll also want to verify all the loans on the property. So David, this is your question. Yes, we always verify the loans to make sure we're buying something, the thing that we're buying doesn't have $10 million worth of judgments, right? And you want to understand the terms of the existing note. Sometimes there will be surprises. I looked at a seller's note recently, and it was a shared appreciation mortgage, which I'd always thought was like spotting Sasquatch, like is something you hear about, but something you never see. Occasionally you'll find something like that that will change how you evaluate the deal. A couple more tricky details. You'll want to change the mailing address for the loan statements. You'll do this by calling the customer service center or even doing it on the online account. Because occasionally the lender may send you a refund check for the escrow. Occasionally the lender may change your monthly payment, especially if it is something that's escrowed. Usually every March, the lender goes through an escrow analysis and says, Dear Joe, you can either increase your monthly payment to us by $65.43, or you can just write us a check right now for $850 and then you can keep your payment exactly the same going forward if there's an escrow increase and your balance is not enough in your escrow account to cover it. If there is an escrow decrease because they overcalculated something, by law they have to return to you any amount that's over a certain amount. So they will sometimes send you a check. If you get a check in Charles's name and you want to cash that, you'll want to make sure it gets sent to your address and not to Charles's address, because what will Charles do when he gets that check? Greatest day in the world. Yes, you will cash your check, right? Even though you're the one who have been making the escrow payments on it. So you'll want to make it payable. You can't make it payable to you, but you'll want to make sure the check gets to you. Now, what's the instrument that we will use to allow us to cash this check? A limited power of attorney. Okay. Oh, this last one is an important one too. 1098s. Because it is an interest-bearing loan, every year by January 31st, your lender sends you a 1098 interest expense statement. You were the one, as the investor, who paid the interest on that property, so you are the one who actually gets to write off that interest expense on your Schedule E on your tax return for that.
The seller doesn't have to sign anything.
Seller does not have to sign anything. Yep. I have tested this with the IRS personally, as I got a love letter about 3 or 4 years ago from the IRS that said, "Dear Shanoa, hi, you. Hey, your social security number is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, or 9, or 7. And we see that you're claiming a 1098 interest expense for all of these other social security numbers. Shanoa, what's going on here? We think you've made a mistake. Please write us a check for $52,335. Yes. So I got to step out of my ivory tower, okay? And I got to put into practice what both my attorney has told me and what my CPA has told me, which is because you are the one who's making the interest payments, because you're the one who's making the monthly payments, only you are the one who is allowed to write off this as an interest expense. And I thought, yay, I get to test this for all of you guys. You're welcome, yeah? So I sent the IRS a letter back saying that I bought these properties subject to the existing financing. I showed them a copy of the HUD where it transferred, or where I purchased it, and I showed them a copy of the 1098 interest expense statements that I had mailed to me, sent all that documentation back to the IRS, and the IRS sent me back a letter that said, "Dear Shanoa, thank you for being so conscientious and thorough. Our work here is done." And I thought, yay! This stuff really does work. Here's a sample authorization to release loan information. Again, this just authorizes, in this case, me to get information on the payoff, the principal and escrow balances, reinstatement, etc. You can find one of these online. Just Google authorization to release. The truth about buying subject to is that this strategy works. Many people don't believe it will work, and most of the time, new investors don't believe it will work because you guys are too entrenched in how you are living right now. And you're not putting yourself in the shoes of the homeowner who is in a lot of trouble, okay? And you think of all of these objections, and you can't get over in your mind why you would ever let someone buy your property subject to, so you don't think it would work with someone else. Guys, these people that we're buying houses from, they are not you, and that's the big differentiation that you have to get past. The whole truth is, it does eventually get awkward managing someone else's loan, getting the 1098 interest statements, changing the monthly payments as the escrow changes, but it's definitely worth it. And for us, we use it whenever we can, because for us, what we found is it's some of the cheapest money that we can get access to. And then for us, for our rental properties, at some point, you stop being able to get loans from a regular lender for your rental properties. So this is a great way to continue to buy rental properties, for example, and continue to grow your wealth, grow your cash flow as a real estate investor without having to rely on a bank to help you. Guys, thank you for coming out tonight and listening. And I'm going to for those of you who don't have any questions, I'll let you go. For those of you who have questions, I'll continue to answer them. Yes, Michael?
When wouldn't